Hello and welcome to Let's Rock the Financials. This is going to be a content-rich webinar in which I'll share with you some of the ways in which you can rock the financials in your business, how you can get financial control, how you can get some financial zen. I'm Gillian Pritchett and I've been helping entrepreneurs around the world for quite a few years now. I help them develop and evaluate business ideas. I help them understand their marketplace, competitors and target clients, and I help them develop marketing strategies to become known, liked and trusted. And along the way, in the course of conversations, I discover that in a significant number of occasions, they don't understand the financial aspects of being in business. They're dreading year end, they don't understand what their bookkeeper or accountant is talking to them about. And since I'm a really strong advocate of having financial control in business, it was a no-brainer to develop my Rock the Financials program. And so this webinar is all about how to get financial control in your business. In fact, you could even say that I'm on a mission here, trying to help business owners get a grip on the financial side of being in business. So let me explain to you why it's really important to control the financial side of your business. Well, if you rock the financials, then there's no more lying awake at night worrying about paying bills. There's no more hustling to get paid by your clients because you know who owes you money and you can go after them for it. You'll have a business that can afford to pay you a regular salary. You know whether that business is really profitable or not. You'll know what your current cash flow status is. There'll be no more dreading year-end tax filings. And you'll know if you have sufficient funds to pay your taxes. And you can make sure you get paid what you know you're worth. And all of this comes down to having financial control. But first of all, let's check if you have financial control. Do you have all your financial records organized and up to date? Do you know how much your business costs to run? Do you keep those business costs under control? Do you know how profitable your business really is? Do you know your current cash flow situation? Do you know how much interest your credit card companies charge you? Do you have money set aside as a cushion? Do you put money aside as soon as you earn it to cover tax payments due later? Do you know what your survival numbers are? If you answered no to just one of these questions, then you don't have good financial control over your business. You have financial control when all your invoices and receipts are numbered, recorded and filed. Yes, I know, sounds boring and tedious, but trust me, if you do it that way, it saves a lot of headaches and pain later on, especially at year end. You've got financial control when there are no receipts lurking in drawers waiting to be recorded. You don't have a pile of supplier invoices waiting to be paid. And you know what your business expenses are and you can justify them. You have financial control when you know which clients owe you money, how much and since when. You know exactly how much money you have at the bank. You know how profitable your business really is. You've got money set aside for tax payments. 80% of businesses fail in the first 5 years, and one of the main reasons is poor financial control. So please don't be a statistic. Let's look at the 7 steps to financial control. They're not rocket science, they're not complicated, they might be a bit tedious to begin with, but once you get used to them, trust me, you'll enjoy taking control of the financial side of your business. So what are the 7 steps to financial control? You need to understand key accounting concepts and terms. I'm not asking you to go out and do evening classes in bookkeeping or qualify as an accountant. Just know the key accounting concepts and terms, so that you can have a meaningful discussion with your bookkeeper or accountant if you use them. Keep the right records. Monitor your cash flow. produce and review reports, control costs, take action when you can see problems brewing, make a date to do this on a regular basis. So let's look at these in more detail. Let's look at step 1, understanding key financial terms and concepts. What are these? Well, I want to introduce you to Lucy Lemonade. It's a little girl that has a lemonade stand every summer, and she sells lemonade to people. So when she started selling her homemade lemonade, because her dad was an accountant, he taught her some of the essentials of the financial aspects of being in business. When she started that business, she had some start-up costs. The lemons, the sugar, her equipment, pitchers and cups, having a stand and some advertising posters. These were her start-up costs. But she also had running costs, those costs that occur week after week, month after month. She needs to buy lemons, more sugar, more cups. She needs to make repayments on the loan she had for the stand. And she'll need to buy more supplies of posters as time goes along. Now, it's really important to know which of her costs are fixed and which are variable. The fixed costs are the posters, the equipment, pictures, the lemonade stand. The variable costs are the lemons, sugar and cups. Why do these matter? They matter when Lucy wants to calculate how many cups of lemonade she needs to sell to cover all her costs, and this is called her break-even point. So how many cups of lemonade must Lucy sell to break even? The break-even point is where Lucy's total sales and total costs are equal. She doesn't make a profit, she doesn't make a loss, she's at break-even. To calculate her break-even point, Lucy needs to know her fixed costs and her variable costs. She also needs to calculate what we call the contribution, i.e. the selling price of a cup of lemonade less the direct costs. This is the money that contributes towards overheads, such as marketing costs, repayment of the loan for the lemonade stand. Are you with me at this point? We need to work out the difference between the selling price and the direct costs, which gives the contribution that will cover overheads, marketing costs, repayment of the loan. It's an important concept, this. So here's some numbers. Please do not take this moment to go away and get a cup of coffee. Stay with me on this. She sells her lemonade at 90 cents a cup. Her variable costs, the lemons, the sugar and the cups, are 50 cents a cup. So as you can see, if you deduct 50 from 90, the contribution is 40 cents. Now her fixed costs are $30 a month. So what are we going to do here? We are going to divide the $30 by the contribution of 40 cents. And this will tell you how much she needs to sell each month to break even. She needs to sell 75 cups of lemonade each month to break even. If she does that, she's covering the variable costs, the lemons, the sugar, the cups, and she's also contributing towards the monthly fixed costs, her marketing and her loan repayments. And she has one source of income, sales of lemonade. Her business is quite simple at this point. It's only one source of income, selling cups of lemonade. So has she made a profit or a loss? If Lucy takes her income and deducts her expenses, then this is how much profit or loss she has made up to that date. You really do need to know if your business is profitable. If it isn't, then either your cost base is too high and or you're not pricing your products or services at the right level. And it could simply be that you're offering products and services that people don't want to buy, so you're not selling and you're not covering your costs. Step 2 is keeping records. This is step 2 of getting financial control over your business. Why do we want to keep records? Good financial records contribute to your business success. They enable you to produce the reports you need to monitor what's happening in your business. They make life easier when the time comes to do tax filings. Some of the key records to maintain are your sales figures, by product or by service line. Keep records of the people that owe you money, your debtors. Keep a record of the money that you owe. Your expenses, your payroll costs if you have permanent staff, your fixed assets, things like table, chairs, car, equipment. Inventory. If you're making product, maybe you've got raw goods, maybe you've got final products. Bank statements. And the bank reconciliations that you do. And let's look at some of these in more detail. Your sales records. Keep a record of all sales. Have a unique number for each invoice. And what I do, I have a unique number by client. I have a unique reference. So if I would do something for Exeter University, I would probably call the invoice EXU1-18. And then the next invoice for them would be EXU2-18. Why do I do this? For marketing reasons. I don't necessarily want my clients to know how many people I'm invoicing. So if you just number every invoice for the year sequentially, regardless of who the client is, people can see whether you've invoiced once or twice or 50 times or whatever. And they'll use that to make judgments about your business. And that's not a good idea. Record the key details in your sales register. That might be an Excel spreadsheet, it might be a ledger book if you're a bit more old-fashioned with paper and pen. You may be using an accounting system, but register the sales. Register your expenses. Keep all your receipts, number them before you enter them into your expenses register. Photocopy all heat printed receipts because these fade. I got caught out when I lived in Canada. I was subject to a tax audit. And unfortunately, it was the first year of my business that they were auditing, several years down the track, and the equipment that I bought, all the invoices, all the receipts for the expenses, had faded. And so all those expenses I claimed were disallowed, and as a consequence, I owed them money on my earnings. And because in the eyes of the Quebec government I hadn't paid, I had to pay fines and penalties. Not a good experience, and not one I recommend. Debtors. Whenever you send out an invoice, record the number, the date, the name of the client, the amount. When they pay, record the date next to the entry for that invoice. And at the end of the month, chase all the people who have owed you money for more than a couple of weeks. Don't be shy about it. You've done the work, they owe you the money. If you're uncomfortable phoning them and asking for that money, get somebody else to do it. If you're doing it by email and you don't want your name on that email, have an imaginary virtual assistant. Have Mary or somebody else write to them. Cash flow. I can't stress the importance of cash flow too much. Profit does not pay the bills, cash does. Sales do not equal cash. Sales is simply an accounting term. Your business needs dollars or pounds or euros in the bank. If the cash flowing into your business exceeds cash flowing out, you can still operate. If the cash flowing out of your business exceeds cash flowing in your business, it runs out of cash and it grinds to a halt. Even if a cash deficit is only for a short period of time, it can put you out of business. So how do you build a cash flow forecast? Start with cash at the beginning of the month. Add receipts during the month. Subtract payments made during the month. And that leaves you the cash you have at the month end. And this is carried forward to the following month. That part is the mechanics, that part is simple. What gets a bit trickier is you need to forecast your sales. And be prudent, don't be over optimistic here. You need to forecast when clients will pay you. Don't be too optimistic, look at the less likely case. Understand the seasonality of your business. Identify cash outflows. What are the expenses that are going to take money out of your bank account? Fixed expenses are relatively easy. You know when the rent's going to be paid, you know when the electric bill will come in. The challenge is more your variable expenses, because they'll depend on sales and other factors that perhaps are not quite so easy to predict. As I've said, always overestimate the time it will take to receive payments. Assume that some, if not all, suppliers will ask for payments in advance until you've built a reputation with them. Obviously, if you're a services-based business, that isn't relevant to you, but if you're a product-based business, it is. Cash flow requires you to do bank reconciliations. It's the only way you can know exactly how much money you really have in the bank. Because what's sitting on your bank statement doesn't take account of money that's going to be paid in because somebody's giving you some cash or some checks that you're going to pay in. And it may be that you've made some payments, you've sent checks to people, and they haven't cleared them yet. So for your bank reconciliations, usually you take the end balance on your bank statement and then match it back to your own records. As I've already said to you, the end balance on the bank statement won't necessarily match the balance in your records. The checks you've written out, that you've recorded, they haven't been processed and paid by your bank. There may be service or other charges that your bank will deduct that you haven't recorded in your records. And I can't stress enough how important it is to do a bank reconciliation so that you know how much money you really do have at the bank. So let's go back to our friend Lucy. Take a look at her bank reconciliations. So when she does her bank reconciliation, she writes down the balance on her bank account. She then adds the checks that she's paid in which haven't yet been posted to her bank account. She deducts the checks that she's written out to clients but which have not yet gone through her bank. And so this is an example of what a bank reconciliation might look like. So as you can see, the balance on the bank statement is 9,200. But in the cash book it's 7,200. You need to produce and review your reports. Reports tell you how your business is performing, your cash flow situation, whether you need to take action, whether you can invest. You need to have your sales minus expenses on a monthly, quarterly, annual basis. You need to know money that's owed to you, who by, how much and since when. And the accounting term for this is accounts receivable. You need to know the money that you owe. This is accounts payable. You need to know your current and your projected cash flow. It's really important to control the costs of your business. It's important to know what those costs actually are, and the best way to do this is to keep track of your expenses. So for every purchase you make for your business, make sure that it's supported by some type of record that shows the date, the amount, any applicable taxes and other relevant information about the purchase. In jurisdictions where there's value-added tax, VAT, or sales taxes, a copy of the credit card payment is unlikely to be accepted by the tax authorities. You need the till receipt or a receipt for tax purposes. And it's a really good idea to have a system to keep track of expenses. If you already have one, that's great. If not, now's the time to set one up. So here's a suggested process for recording receipts, just in case you don't have one. Keep receipts or other acceptable records for every payment made in relation to your business. Give each receipt a sequential number and file them in number order. Photocopy heat printed receipts as these fade very quickly. As I discovered to my cost when I lived in Montreal, a few years into my business, I was subject to a tax audit for the first year of my business. I handed over a printout of my spreadsheets, all of my receipts. The lady from tax office said to me, "This is beautiful, I've never seen anything presented so nicely," and I'm thinking like, this is great. And then at the end of it, when she's audited it and I'm called back in, she says to me, "I'm very sorry, but I cannot accept these faded invoices. Unfortunately, they're for the computer and printer and other more expensive equipment that you bought. I have to disallow all of these expenses, which means that you made more profit. You should have paid us more tax, and unfortunately, not only do I have to claim the tax back from you, I have to claim back the interest on it because it's been unpaid for X number of years, and there should be fines and penalties as well because you didn't pay it." And I'm like, well, my receipts have faded, and she just would not accept it. So be warned, they fade. Make sure you photocopy them. Record the key information of each receipt, so the receipt number, the date, the supplier, the item, the amount, the value added tax or sales taxes, payment method, and the purpose. Either use a paper-based record system, an Excel spreadsheet, or even your chosen accounting software, but keep a record of it. Record everything you buy online straight away. These items are so easy to overlook. We all buy so much online these days, books from Amazon, information products, mentorship programs, hotels, everything. Keep a record of these. Even if you scribble it on a piece of paper and put that piece of paper into a folder, and then later you pull up the correct invoice for it, at least you've got a record that you spent it. For purchases where you usually get a receipt by email, I always suggest that you set up a folder in your email account for those receipts, because you'll need them if you have a tax audit. I'm a bit old-fashioned. I do tend to print the receipt, number it and file it with the others, but that's me. And don't forget, you'll also have payments made direct from your bank account, possibly to your landlord for rent, to utility companies, payments to staff, to people you've outsourced work to, maybe a membership program that you're part of. It's also important to review your expenses from time to time. So I suggest you make a list of all your expenses and review each in turn and ask yourself whether it's really essential to your business. And if it is, how could you reduce that cost? So the following slides give you a few hints on how you might reduce costs. Obviously there's lots of different costs in your business depending on what type of business, whether it's products or services. And we'd be here for a long time if I went through all of them, but this is just to give you a flavour of some of the things you might want to consider. So let's take a look at the expenses you're likely to be incurring. And as we go through these, I suggest you ask yourself whether they're really necessary for your business. Do you need staff? Could you manage with a virtual assistant on an ad hoc basis rather than a full or part-time personal assistant? How about using some student interns? Maybe your local university has a quality MBA program and you could offer a mandate to a student for their work project. Win-win for both of you. Do you need so much space for your office? Do you need to be in a fancy building? Do you really need to be downtown? Could you work from home? Could you borrow a friend's home office if they're out all day and the place is quiet? Maybe you could share an office. Maybe you could rent space in some office space's facility. Do you really need so many domain names? I mean, really? I have to confess, I am very guilty of this. I used to have over 90. I'm now down to 65, which may sound a horrific amount to some of you, but believe me, I worked hard to reduce down to that number. Do you use all the domain names you've bought? At least mine are pointing somewhere. They're pointing to a page, a program or something. But do yours all point somewhere, or are they sitting on GoDaddy? Do you maybe have domain names of programs that you no longer sell? And how many hosting plans do you have? I actually do know of people who have a hosting plan per website, and this really isn't necessary. Nearly all hosting companies allow you to host an unlimited number of websites. Marketing. If you spend your time doing the promo, then attach a cost to it. It's still an expense. If you're not able to do it because your business has taken off, or maybe you're not well or something, you'll have to pay somebody else to do it. So it's an expense. How are you going to cost it? Well, multiply your hourly rate or your average hourly rate by the number of hours you spend doing the promo for your business. That's your marketing expense. And you may well have a shock. Most people do. You'll probably be really shocked by how much time you spend on promo activities just when you look at how much it costs you. And that's time that you could be delivering your services or making more products. And maybe, even if you're good at marketing, even if that's actually your field of specialism, if that's not what your business is about, maybe you should be guiding somebody else to do some of the grunt work of the marketing for you. Just a thought. And do you need all those fancy flyers on high quality paper? The glossy brochures? Could you maybe make your flyers evergreen? As an example, I give talks on marketing and some other business topics, but I never put the dates of the courses on my flyers. I invite people to visit my website or to call me. It has two benefits. I don't risk having out-of-date flyers in venues such as local libraries and business centres. Don't waste money on flyers getting thrown out when the date has passed. But I also have an opportunity to interact with people when they call me. You need to take action. If you're not making a profit, you need to look at your pricing. Do you need to increase your prices? Some people are very happy to charge what they believe they're worth, but some people will be very uncomfortable doing that, and they'll charge very low prices, which means it's not so easy to cover all of your costs. You're not getting such a high salary, and sometimes it can actually have an adverse impact on your credibility. You know, you position yourself as a marketing consultant and you charge £30 an hour. That doesn't sit well with most businesses. They know it costs more than that normally. And so they then start to question your credibility. You need to look at your costs. Is your cost base too high? We've already looked at the importance of reviewing costs. And as I've said, you know, maybe you just have too many domain names. Maybe you've got more than one web hosting company. Maybe you buy loads and loads of information products. Maybe you buy into lots of programs, go on lots of retreats. But do you do anything with the stuff afterwards? Or do you just take it home and file it? Just becomes something extra on the bookcase. What level of debt are you carrying? Can you reduce that? What interest are you paying on loans? Can you clear some of those loans? What about that money that's owing to you? Those clients that haven't paid you? Time to go out and hustle them. Time to really earnestly pursue them for money. And in a worst case scenario, you could use a factoring company who take ownership of the invoice that you've sent out, and they pursue that client for money, and some of them will pay you 80% of that bill. So you might have invoiced for £10,000, you won't get it all back, but you'll get a good proportion of it. So factoring is something to consider. If your cash flow indicates you're going to have a problem paying bills, you need to take immediate steps to remedy this. So go to the bank and ask for an increase in your line of credit. Don't wait until nearer the time. Do it as soon as you've projected the cash flow and seen that in a few months' time you could have some problems. Maybe you need to request a bank loan. Maybe you simply need to increase your prices. Reduce some of your expenses. Chase debtors for payment. If you notice this is becoming a little bit repetitive, you need to keep an eye on your prices. You need to keep a tight control of expenses, your cost base. You need to be totally unembarrassed to chase people for payment. If clients owe you money, chase them for full payment. Maybe get them to agree to a payment plan. So much per week for a few weeks, or so much per month. But never do any more work for them until they pay you. That is an absolute no. And as I've already said, consider factoring. And make it a date. You know, this isn't something you do at year end because you're in a panic. It's not something you sit down and do within 48 hours of listening to this webinar because you're motivated to do it, which is great. You know, don't let me stop you. Just rush out there and do it straight away. That's great. But don't then sit back and relax and say, okay, I've done it. I've sorted out my finances. Make a date that every week you're going to record your expenses. That you're going to review your cash flow. Do a bank reconciliation each month. Keep a close eye and a strong grip on expenses, on getting people that owe you money to pay you. Frequently review your pricing. You know, update those financial records at least weekly. Check your cash flow at least weekly. Monthly bank reconciliation. Check your profit and loss and check this by product line, by service, by information product. Some will be profitable, some might not be. Check who owes you money and chase them for payment. And take appropriate action. Follow these simple rules and you can have financial control. If you've got financial control, then you've got complete financial zen. So it's time to start rocking the financials. If my program appeals to you, it's yours for $37, and there's a special opportunity as part of this webinar. You can have a free copy of Lucy Lemonade. It's a little book that I wrote that helps you understand key accounting terms and concepts. It's quite simplistic, but it makes it all more accessible. And if you've got any questions, feel free to send your questions across.